I'm John Weber with AM Best. Welcome to today's webinar, State of the Medical Professional Liability Market. We have a full program and an outstanding lineup of panelists. AM Best is a rating agency. We will likely mention rating-related issues in today's discussion. If you have any questions about AM Best ratings, please visit our website and click the link for rating services, then the link for ratings processes and definitions. We welcome your participation. If you have questions for today's panel, please email us at webinars@ambest.com, and we're going to do our best to recognize your question during our discussion here today. At this time, let's welcome in our panel. First, we say hello to Brian Atchison. Brian is the President and CEO of MPL Association. Brian, good to see you back here.
Very nice to be here. Thanks very much.
Next, we say hello to Wayne DeNazari. Wayne is the EVP of ISME Mutual Insurance Company. Wayne, welcome.
Good to be here. Thank you.
Next, we say hi to Jim Hurley. Jim is a consulting actuary for Willis Towers Watson. Glad you could join us today, Jim.
Pleasure to be here, John.
From AM Best, we have Sharon Marks. Sharon is a senior financial analyst here at AM Best. Good to have you, Sharon.
Thank you, John.
Last but not least, we have David Blades. David is an associate director here at AM Best. David, good to see you.
Good to see you, John.
And David, we're going to kick things off with you. What's AM Best saying about the MPL market?
All right. Well, from an overall standpoint, we looked at all the financial data that we've compiled from our rated entities, so our statutory entities, and compiled them into our MPL composite that we look at from an overall aggregate perspective. And what I can say is that for another year, operating profitability has been generated by that overall composite. And that's, again, a continuation of what we've seen for at least the last 10 years now in terms of operating profits, although in this year, and I'll talk about it a little bit later, the composite did generate an underwriting loss. But over the long term, the composite has generated better than average profitability in comparison to the total property casualty industry, in addition to increasing aggregate capital and surplus on a year-to-year basis and generating favorable loss reserve development also on an annual basis. And I think that something that's specific to the MPL segment. I think when we look at prior year reserve development, the segment has generated favorable development over a 15-year period from year to year. So again, that's something I think that's very, very specific. I don't know if there's another segment that where we can state that from an overall standpoint. So in those regards, operating profitability again was generated. What we did see and what was interesting, as is shown in Exhibit 2 of our report, is that for the first time in a number of years, on a year-to-year basis, direct premiums written actually increased for the overall composite. We've seen over time a decline, and for the last several years, a year-to-year decline in direct premium written generated by the composite, and that's really kind of been tied to what we talked about a lot in previous reports, sort of the migration of physicians that had been solo practices or small practices kind of moving towards working for hospitals or larger groups. So that's kind of hit the top line premium. But in this year, we actually saw a 3.2% growth in that direct premium written. So again, that was something that's noteworthy from a financial standpoint. That could be a signal that, as we've heard anecdotally from the companies that we rate that come in and talk to our rating analysts, that they are pushing and actually succeeding getting some traction in pushing for some rate increases where they see the need, be it on certain classes or in certain territories. So that's something that I think we'll look to see if this is a trend that continues, but the increase in premium may be reflective of some of those rate increases and the push for some of those rate increases gaining some traction. Now, I will say that the positive operating performance that I've mentioned occurred still, in the face of a number of headwinds that MPL insurers are dealing with. Again, as I mentioned, the migration of physicians to hospitals and to large groups, that's one of the headwinds that's, again, been generating, we've seeing premiums kind of leave, the marketplace in that respect. So from a top line revenue perspective, that's impacted companies. Strategically, they've kind of tried to deal with the competitive marketplace, and again with the decline in premiums through a number of different strategies, geographic and also class of business diversification. So we've seen that. We've also seen a number of companies kind of deal with the prolonged soft market through strategic consolidations, kind of seeing that as the best way forward for their companies. And so we've seen that as well. In addition to a lot of companies, they come and they talk to us about just focusing and honing in on their core, proven core fundamentals and principles, and their core lines of business. That's another way that they're kind of dealing with what we're seeing from a competitive marketplace. But again, there are a number of headwinds that have impacted the marketplace and MPL insurers. And again, another one of the headwinds is just rising loss severity that we've seen in the marketplace. And specifically, we've seen more of a frequency of larger claims, so loss severity rising. And really that's kind of tied to rising litigation costs and rising medical costs. And that's not something that's specifically just endemic to the MPL industry. I think we've seen that from a total industry standpoint, but that's definitely another headwind that's acutely impacting the MPL marketplace. We've also seen increased cyber security concerns. Again, MPL insurers have a wealth of information, a wealth of very valuable personal information in their health records that they keep for their customers. So, from a hacker's standpoint, that information is very attractive, and so cybersecurity concerns are definitely a reality for MPL insurers, and that's something that they continue to have to deal with. We've also seen tort reform in different states continues to be another one of the headwinds that MPL insurers are dealing with, and again, that differs from state to state, but those challenges continue to come, and that's something that we see having some impact from an overall perspective. So considering all the headwinds that I mentioned, despite the fact that, again, operating profitability is generated and premiums increased, and like I said, you can actually look at Exhibit 19 in our report that kind of shows how premiums have kind of dissipated on the physician side and increased for hospitals and other healthcare facilities, so that's something that you can see. But considering those headwinds, AM Best still continues at this point to maintain its negative market outlook on the overall MPL segment. And I think really that's tied to, again, as I mentioned, the diminishing loss reserve cushion that we've seen for MPL insurers. Again, lower to until 2018 top-line premiums decreasing. Also just the overall prolonged soft market conditions and again, the rising loss severity. So that's something that we're going to continue looking at. Look at the end of the year. Again, consider all the factors and how things go into 2019. But for right now, AM Best is still continuing its negative outlook on the overall market.
And I'm sure we're going to be continuing to hear about those headwinds and challenges from our panel here today. Meanwhile, what are we seeing in the way of underwriting results for the sector?
Well, I think there are a number of interesting things from an underwriting perspective, but the first thing I want to mention is that when we looked at the underwriting results, what we did, again, we looked at our overall MPL composite. So that composite is made up of companies that write more than 50% of their business in the medical liability, either claims made or occurrence line of business. So that's specific there. And then we did have to make adjustments for one of the major companies, Medical Liability Mutual Insurance Company, or actually Milmick Insurance Company as it's now called, and a transaction that they had with an affiliated reinsurer. They're part of Berkshire Hathaway, and so they had a very large loss portfolio transfer that was very impactful to the overall composite results. And so the results that we have in our report are reflective of the adjustments that we tried to make to kind of back out the impact of that that large transaction, and really try and see from a fundamental perspective what's really going on in the marketplace. So with that said, our analysis shows that the MPL sector generated an underwriting loss, or has generated an underwriting loss in each of the last 3 years. The underwriting loss hasn't been huge, and actually it's slightly larger in 2018 than when it's in 2017, and that's reflective of net earned premiums increasing, but losses and loss adjustment expenses incurred actually going up a little more than net earned premiums. So what we saw is a 1-point increase in the overall loss and loss adjustment expense ratio. other underwriting expenses and policyholder dividends generally stayed the same. So we saw that the combined ratio really, which was also up by 1 point, was again really tied to the loss and loss adjustment expense ratio. In Exhibit 4 of our report, we actually show that losses, like I said, losses increased, but or I should say premiums increased, but again, we're slightly outpaced by the losses. And again, one of the things we have to consider when we're looking at the MPL and considering them in the totality of the property casualty market is that MPL insurers benefit from the fact that their books of business aren't really prone to the kind of catastrophe losses that we've seen in the overall marketplace that have impacted from a catastrophe loss standpoint and also from wildfires and things that really were a large part of the story in 2018 didn't really have that big of an impact on MPL insurers. So that's just when we're looking at that in comparison with the total property casualty market. As depicted in Exhibit 6 of our report, when we look at the prior year loss reserve development, and something that we've reported in each of our last several reports, annual reports on the MPL market segment, we've seen what was once a very robust reserve cushion from a prior year loss reserve development standpoint kind of continue the path of dissipating on a year-to-year basis. Exhibit 6 actually shows the impact that the MILMIC loss portfolio transfer had on 2018. It was very similar to what we saw in 2014 with MedPro, both of them making their sessions or having their loss portfolio transfer deals with National Indemnity. But the overall reserve development has been dissipating year by year. And again, that's something that companies have utilized and counted on to lower their overall calendar year results. So the impact of that, if that continues dissipating, again, that's a negative headwind that's really impactful from AM Best's standpoint in terms of what annual calendar year results will look like. So we'll continue looking at that. And like I said, from a standpoint of favorable development, again, it still existed in 2018. The favorable impact on prior year loss reserve development was about 15.5 points in 2018, lower than the prior year of 17.8 points on the combined ratio. So again, we're seeing a lesser positive impact from prior year loss reserve development. From an operating perspective, again, the sector performed well despite the underwriting loss. Net investment income and other income was enough to offset that loss and generate pre-tax income. And that pre-tax income for the segment actually increased by 39% year over year. And then net income benefiting from realized investment gains increased by 55%. So again, there were definitely some positives from an overall operating standpoint. And that really reflects the resiliency of the marketplace to me, because again, relatively small underwriting loss, but the success of these companies from an overall operating standpoint, despite, like I said, the less favorable reserve development, I think we see that as that operating performance is definitely a positive that we see going forward. And again, we'll continue looking at that as we consider our market outlook when we consider again later this year.
Sharon, what are we looking at in the way of investment returns for MPL writers?
Sure. For 2018, we saw growth in net investment income and realized capital gains for the year, but their impact on total return on invested assets was muted by unrealized losses for the year. So in total, return on invested assets actually declined down to 1.2% for the year compared to 6% in 2017. If you take a closer look at the numbers on Exhibit 3, you can see the net investment income grew 20%. That really reflects improvement in yields as the invested asset base did decline. You see the growth in realized capital gains as well, up about 40% for the year. What we don't see in the exhibit, though, is the impact of those unrealized losses. They totaled $1.2 billion for the sector in 2018 compared to an unrealized capital gain of $953 million in 2017. That was the result of the significant downturn in the equity markets in the fourth quarter. A lot of that has been reversed in the first quarter of 2019. The impact of those unrealized losses, though, I think highlights one of the changes we've seen in the segment's investment portfolios in recent years, and that's been a move to take on more investment risk in exchange for higher yields. If you take a look at Exhibit 7, which has the segment's balance sheet, you can see that equity investments as a percentage of total assets has increased during that time, as did common stock leverage. It's not excessive for the segment, but it does introduce some volatility in total returns and surplus growth.
And what were we looking at in the way of capital and surplus?
Sure. Overall, we continue to view the rating units that we follow in the segment as very well capitalized. We have about 75% of our U.S. MPL rating units currently with the strongest balance sheet strength assessment. And that speaks to not only how we view their risk-adjusted capital, but also their overall balance sheet strength. Looking at the surplus trends, if you take a look back at that Exhibit 7, which had the balance sheet, you can see that statutory surplus declined by 10% for the year to just about $18.6 billion, following growth of about 3.9% the prior year. Most of that was driven by an increase in stockholder dividend payments. And a lot of that was due to a large dividend payment from Milmic up to its new parent company that's part of Berkshire Hathaway, the transaction that David had alluded to earlier. Also, the extraordinary unrealized losses experienced by the sector also impacted surplus growth in 2018.
And how's the sector doing when it comes to pricing?
Sure. The sector is still in a prolonged soft market, right? So prices are still depressed, but we are anecdotally starting to hear about companies starting to take rate increases in our meetings with companies. Nothing substantial, nothing really meaningful. We're talking about small single-digit percentages at this point, but that's a relatively new development. It's something we really hadn't been hearing about just a year ago. And as David alluded to as well, premiums are up for the year. When we looked further into that, you see that's mostly driven by hospitals and healthcare facilities, but the premiums for physicians continue to decline, but the rate of that decline has started to slow down. So that is perhaps maybe suggesting that some of the rate pressures are starting to stabilize in that market, given the continued pressures on demand.
Thanks, Sharon. And David, are there any particular trends that you're keeping an eye on when it comes to reserving or anything like that?
Well, definitely. I think I'll provide a couple of highlights from AM Best's perspective, on reserves. We definitely had our senior actuary pour over a lot of the numbers and contribute to the analysis from an overall reserve standpoint. But please understand, I understand I'm not an actuary. I'm not going to play one on this webinar, and I'll at least give some basic thoughts. But I'm really be interested in hearing what Jim has to say from a loss reserve standpoint and overall trends. Again, as I mentioned earlier, favorable reserve development continued in 2018, and it's long-term been a hallmark, for the MPL industry. As I mentioned, the 15 years of favorable development on a year-to-year basis. AM Best believes the industry's booked net loss and LAE expenses overall continue to be redundant. Like I said, the estimated redundancy is dissipating a little bit. At the end of 2018, as shown in Exhibit 9 of the report, we estimated that the booked net loss and LAE reserves were $2 billion redundant after reflecting on $800 million of statutory discount. And that compares to, that's probably less than half of the redundancy that we estimated 5 years ago. So again, that kind of focuses in on the dissipating reserve cushion from that perspective. Calculated calendar year loss and LAE ratio again is lower than the accident year ultimate loss and LAE ratio, and that's indicative of overall weaker reserve position. And we think if that current gap continues between the two continues to widen, we think from a redundancy standpoint that we'll see the redundancy really start to dissipate even faster than we've seen it the last few years. So again, that's something that we will be monitoring very closely from an overall perspective. Again, reserve positions do vary by insurer. So it's this is kind of talking in the aggregate. There are a number of insurers who are really still continue to be really, really strong in terms of their overall reserve position. Like I said, that factors into the overall balance sheet strength assessment, as Sharon mentioned earlier, that from an overall composite standpoint, the balance sheet assessment for the NPL insurers continues to be very strong from that perspective. You look at Exhibit 11 in our report, we show that over time, over a long period of time, going back to the late 90s and early 2000s, loss reserve position for the industry has kind of reflected a number of swings back early 2000s. Again, you saw unfavorable development, but since 2003, as is reflected in that exhibit, we've seen favorable reserve development, although in the direction that we see now, you see, again, that cushion dissipating. And so we think, the determination on whether, reserves are really weakening, we look at that and we see the decline in the average reserve reserves. If that was offset by a decline overall from a severity standpoint, it wouldn't be as much of a problem, but declining average reserves, what we've seen is that they're not declining, or severity reserves are not declining at the same rate. So again, that also reflects into a weaker overall position from a reserve perspective. And again, that's something that we will keep our eye on. But like I said, I'm interested to hear what the other panelists have to say about that as well.
And I think, Jim, that's your cue then.
Well, I'm not going to take on the subject of reserving, but I will take on the subject of what's happening with contributors to the reserving, which is frequency and severity. I'll take the easier of the two first, because frequency is a little easier to talk about than perhaps severity, which has a little more complexity to it. But frequency, as has been described in most discussions of it in the most recent several years, continues to be operating in pretty much a flat plane. Really a little thrashing up and down, which is typical for frequency from year to year for a given book of business. Yet overall, looking at the data in the aggregate and looking at it state by state, it's still operating at a fairly flat level. So after the declines we've seen in years past, it seems to have flattened out and stabilized, not making a significant contribution to the change in reserve position as it has in the past. In the case of severity, the subject's a little more complicated, as is probably no surprise, and you need to probably decouple it a little bit or break it down into its pieces. The ALAE is probably the easiest of the two to talk about. Allocated loss adjustment expense, or the defense costs spent to defend claims. They come in a number of varieties. Defense costs include expert witness costs, lawyers' fees, and those types of things. And that's been a place where we've seen some upward pressure over the long term, probably mid-single digits and sustained at that level, some places higher. It's also an area where companies have been focusing their attention to try and do better in trying to contain that rate of increase, and with some success in doing that. So ALAE continues to move up, but probably not at the same pace that we have seen it if you went back 1 or 2 years. Still upward pressure. From the standpoint of indemnity, it's a little even more complicated. It's been fairly modest in its increase, probably at a lesser rate than the ALAE we talked about a moment ago, yet there are a lot of dynamics in play that are putting pressure on that particular component of severity as well. We've heard a lot of comments about the increased number of claims at large values. We have another pressure that comes from the standpoint, from the overall NPL space standpoint, of the combination of physicians and hospitals into one entity, which then creates the opportunity for a larger single claim rather than perhaps 2 smaller claims, which comes through in the data in terms of higher severity. So there are things from that standpoint that give the appearance of higher cost, and in terms of severity, higher severity if you look at it from just the cost per claim, yet the overall cost may not be as significantly impacted when you consider the 2 sources of severity from the past. So there's lots of things that make it confusing to look at severity. With that said, there's no doubt that we are beginning to see, particularly probably on the facility side of the business, the hospital side of the business, a larger number of higher verdicts that are coming through. And unfortunately, verdicts set the stage for what claims people will generally use as the basis for their determination about settlements. So when verdicts start to go up, there's pressure on claims people to think about those verdicts in terms of what they do in making settlements. So it can have an impact on moving the entire level of the severity up as a consequence of these increased verdicts. And as I said, we are seeing that happen if not because of the dynamics of physicians and hospitals, just because of the fact that there are juries and outcomes that are producing those higher verdicts. So a little bit of pressure coming through there. To date, we hadn't seen a lot of that come through in the lower levels, in the first $1 million limits of indemnity. But there are some beginning signals, even in those contained layers, of upward push on severity on the indemnity side as well. So they're the beginning signals of that working its way through the data. So pressure from the standpoint of severity as well.
Let's shift gears completely. Brian, any regulatory or legislative concerns on your mind?
Plenty. Well, throughout the states as well as in Washington. There's a lot of change going on in the states, and there's a lot of activity in Washington. So I'll just hit on a few. We've seen some unfortunate developments from a legislative standpoint in places like Colorado, where they've weakened the caps, in Washington State, where they've expanded the scope of damages. Oklahoma, we've seen the Supreme Court overturning their law for caps on damages. We've seen an effort in Pennsylvania to try to turn back the clock and allow plaintiffs to bring their claims in any jurisdiction within the state instead of where the incident occurred. We've been working with a coalition to deal with that. South Carolina has been an interesting place where the JUA, like too many of them, were allowed to continue to compete in the marketplace and essentially is underwater, and now the industry is being asked to step in and help bail that out. And a coalition has come together to try to help work with the state of South Carolina for a solution there. So there's a lot going on in the state, and that's just the tip of the iceberg. In Washington, while I think there's a lot of fixation on some of the headline-grabbing news, we're continuing to work with a bipartisan group of the House and the Senate on a couple of important issues. And it was interesting to see that the administration's budget that was just introduced did include, in fact, medical liability tort reform in that. Perhaps even more surprising, because frankly, in terms of that legislation, we wouldn't anticipate that would have legs, given the divided nature of Congress, to really go far in this session of Congress. But much to the surprise of many, about 10 days ago, the U.S. Congressional Budget Office, which is the bipartisan or nonpartisan sort of financial think tank of the congressional arm of government, issued a request for comment on a 25-page document to study the impact of medical professional liability on the financial nature of the nation's budget. And so we're going to be looking closely at that and working with members of Congress on both sides to try to get behind what's their interest there, what's their thinking there, what is the end game, if there is one. It certainly opens up either the opportunity or Pandora's box for a lot of mischief if that were allowed to serve as some sort of vehicle for elements that were not favorable to the medical professional liability community. I think overall, when you look at what's happening, the most recent election and upcoming elections, I think we're just looking at the typical swing of pendulums. I think there's a lot of the pundits anticipate, both in the states where you saw the party that is more favorable to the plaintiff side, have a lot of wins and increase their strength in a lot of states. That may continue to happen in the states. That also may continue to happen in Washington. If that happens, you're dealing with a climate that could be problematic for the medical professional liability community. So I think that we're remaining vigilant, and all of our members, I think, are paying close attention to what's going on in the states. And our biggest issue is telemedicine, in terms of trying to understand, trying to help everybody understand who's got a stake in this about the downstream cost of telemedicine. When care is delivered across state lines, but it may not be realized or anticipated, are those products being priced, are those policies being priced appropriately for a physician in a state that may have very strong tort reforms delivering care and treatment or diagnosis to a patient in a very in a state that has no tort reform in it. And right now that is an absolute blank slate on a national basis. And right now there's some very strong interest groups that are pushing for that the location of the patient be determinative as to what rules and forums will apply. And if that were to become the law of the nation, that would be very problematic, I think, for a lot of our member companies.
Leads right into my next question. What do you see as the biggest issues from a regulatory standpoint that are affecting MPL writers?
Well, I think that's near the top of the list. The NAIs, the National Association of Insurance Commissioners, you always have to keep an eye on them, even though that acronym is sometimes referred to as no action is contemplated. Actually, they do get things done once in a while. And right now, the states are up against a 2020 deadline to put in place the new financial solvency accreditation standards, which impose much more rigorous financial reporting requirements on companies with over $500 million in annual premium, as well as other requirements. And even though a company may not have more than $500 million in premium, I don't think anyone is kidding themselves that those standards won't bleed down and be applied by many of the state insurance departments against most of the companies doing business. So that's one. And cybersecurity, the states are looking at imposing regulations on cybersecurity, and we're hoping if they're going to do it, they do it in a somewhat consistent fashion. So, there's a lot going on from a regulatory standpoint.
Let's look at mergers and acquisitions. How are the conditions for M&A? Jim, do you want to take that up?
Sure, I'll start. It seems to me that the conditions are supportive of that from the standpoint of both the pressures on the marketplace from an exposure and volume of business standpoint for some companies, as well as the underlying capital and surplus positions of the companies be able to make acquisitions or make arrangements to do that. And as Sharon mentioned, while they took a bit of a hit at year end with the equity adjustment that happened in the fourth quarter, the rebound back at the beginning of the first quarter puts them back where they were before. So from a capitalization standpoint, there's a lot of capital looking for a place to go, a place to deploy, a place to be used effectively, and therefore that makes companies interested in talking about opportunities with other companies. And despite all the merger and acquisition activity that's happened, there are still plenty of opportunities, plenty of targets, if you will, out there that are available. They may not be the same size and scope of some of the recent deals that were talked about, but there are lots of companies out there that are the right size for other companies to think about inquiring about, perhaps exploring opportunities with merger and acquisition on their mind. So I think the conditions are ripe for that because of the marketplace conditions and because of the capital position of these companies.
Yeah, I'll add a couple comments on that because I think we're still seeing hospitals acquiring other hospitals, and that consolidation is one aspect that it seems to be generating quite a few consolidations for also groups then being acquired by hospitals. I think that it has an impact on the overall MPL sector, and so you're seeing these consolidations occur with declining premium because, as Jim said, it's less premium when you get right down to it for the consolidations that are taking place. We're also seeing some joint alliances where instead of a merger or acquisition, companies agree to some type of joint alliance, whether it's in the hospital sector and such. That hasn't taken as much traction as just general mergers or acquisitions because of the alignment of interest when you form a joint alliance. There has been several in the industry, but they don't seem to be working as smoothly as other type of acquisitions.
And I want to keep it with you for a moment there.
Okay.
Your company is expanding its coverage focus, ISME. What strategy are you pursuing there?
Well, ISME is converting from a monoline, monostate company. I think every company in this sector is strongly capitalized, strong balance sheets for the most part, and you have to make decisions on what you're going to do and how you're going to operate for the consolidations and the declining premium and for the healthcare in the future. When you look at physicians now, it's much more dynamic on what they need for their insurance needs. There's a migration to the employed sector as well. Facilities are taking over a much stronger role within healthcare. All types of facilities, whether it's surgery centers, you see them all over the country now, and all of those are buying separate insurance. So 3 or 4 years ago, ISME started diversifying, looking at other areas to expand the platform. I think each company has to make a decision on what they want to do for the future and how they want to operate. It's very difficult to be in one state or one region and not have a broader platform. So we've expanded from an admitted standpoint into about 15 states, and from an excess and surplus lines to right facilities, hospital business, other type opportunities. We're on a national platform. Expansion is step by step. It's not a particularly good time to expand. There's a lot of capital in the market, and I think when you look at what is the direction of any company now for expansion, it has to be relatively conservative. Where we're getting traction from growth or premium writings is from brokers that we have strong relationships with, that know how we service business, how we pay claims, but it's a slow go. It's very competitive from a pricing standpoint still, and so we're taking a step-by-step approach, but to broaden the platform.
All right, thank you, Wayne. Now, we can't go anywhere these days without talking about analytics. And David, I would just want to ask you, what role is predictive analytics playing in the NPL sector?
I think just in general, I think, predictive analytics, more and more companies have kind of focused on areas where they think they can utilize predictive analytics to help them from an underwriting standpoint, claim standpoint. There have been a number of companies in the overall property casualty space that have been utilizing data analytics for, more than 20 years. But I think what we're seeing, especially for a lot of the smaller companies, I think, there are measures that a lot of those companies can utilize and can implement more quickly that might have a more measurable and impactful, effect on their overall operations. But I think, for all companies, the degree to which greater efficiency in handling business and handling, for NPL companies and handling, health records that might enhance, not only, profitability from the standpoint of greater efficiency, but also obviously help avoid, adverse medical outcomes, and also enhance patient safety. I think that's something that, to the extent that the application of data analytics can help companies do that. I think NPL companies do that. I think that's going to be something that they'll continue to go forward with, and that's something that some of the companies talk to us about measures that they've, injected in their operations, really towards that end or focused on that end. But I think, understanding and managing the overall effectiveness of some of these, endeavors is really something that we look at. It's not a silver bullet type of thing where one size fits all. There've been analytical processes that have been undertaken that really, for some of the companies, haven't had the bottom line impact that they may have thought. So resources are being expended, and to some extent, the cost-benefit analysis hasn't worked out in some respect for some companies. So again, it's not a situation where analytics in and of itself is the answer. It's got to be effective. Effective analytics. And again, we talk to a lot of the companies about different endeavors and different initiatives that they've put forth. And I think, we'll continue to look at that. And I think, again, finding the measurable differences from a bottom line perspective is really, what we're looking at. And when we talk to companies, to the extent that they can articulate that to us and show it to us in a measurable way, that's where it'll have a positive impact from a rating perspective for AM Best.
All right, thank you, David. I would like to remind our viewers that if they have a question for our panelists, they can send it in to us at webinars@ambest.com, and we're going to do our best to recognize it here today. We do have a question from a viewer. Wayne, I'm going to direct this your way. What is the condition of support from the reinsurers for MPL cover now, and what is forecast for support going forward, 12 to 24 months? You want to take a stab at that?
Sure. Well, the reinsurance market is highly capitalized as well. And over the past several years, the reinsurers have supported a number of companies in the MPL sector. I think it's fair to say as the declining premiums have occurred on the primary companies, that the premium has also declined from a reinsurance standpoint. So today we find reinsurers where there's still strong capacity, strong support, but the margins for reinsurers has reduced down based on the excess layers or quota shares that they're taking on. There's still plenty of capacity. I think you're seeing the types of reinsurance structures change from straight quota shares to maybe clash covers or excess to a more financial-oriented type of structures where you might have aggregate stop loss or just straight excess programs and such. But again, I think reinsurers are on the edge of converting some of the programs, and you're seeing a lot of MPL companies also restructure their reinsurance for a number of reasons, for efficiency and cost and overall coverage. With all the healthcare changes, also the dynamics of their reinsurance programs have changed.
Just to piggyback on that, I think that's something that we've heard in our interaction with the companies. Again, like you said, as things have changed in the overall healthcare market, the structure of reinsurance coverage for some companies, as they're taking a chance and looking at it strategically, I think they've changed up, the way they're looking at it and what they think is the best reinsurance solution for them. So just to piggyback on Wayne's point, I think that's something that we're hearing more, and I would anticipate we'll continue to see that manifest itself on a year-over-year basis as companies, again, continue to look at how they're attacking the marketplace, how the overall changes in the marketplace are impacting them, and what makes the most sense for their overall operation in terms of the reinsurance support that they want.
I think the other thing that adds to that is the fact that the companies are also very well capitalized, and part of their thinking has got to be how better to deploy that capital and their reinsurance needs. So just like Wayne is saying and that David is saying, he's been told by the companies they're reevaluating what portion of the risk they should retain. But with that said, the sense you get, and what I've heard from the reinsurance feedback I've had, is that the market is getting a little tense. It's tightening, and it's likely that as things move forward into the next couple of years, reinsurers are going to be looking to improve the margins as opposed to just be willing to follow along.
Sure. I'll add one other comment to that. On the composites, it really doesn't segment hospital business, and hospital business and the overall sector of hospitals relative to larger claims, severity, frequency of severity, we've seen a tremendous increase in the number of very large claims in the hospital sector. So the reinsurers that we're dealing with, as we've explored the hospital sector as well, we're being very cautious on it, conservative at this stage. It is an area now that is impacting the reinsurance market significantly, whether it's the captives or whether it's the individual insurance carriers that are reinsuring hospital segments. That area has had significant changes within the reinsurance structures, and that's an area where you're going to see. Jim?
I absolutely agree. I mean, everyone was aware that the London market tightened things up a little bit the latter half of last year, and I think partially in response to exactly a lot of those larger claims and larger settlements and verdicts that were coming out, and that certainly over time will probably start having some knock-on effects and some ramifications, and we'll just have to see how that plays out over the next 12 to 24 months.
Is the migration process continuing, Jim? What do you think?
I'm sorry?
The migration process?
Well, I think by migration, what you're referring to is the movement of physicians into employment circumstances. I think it is continuing to happen. We see that happening. We hear the comments from the physician carriers who are oftentimes losers in that game if the employed physicians go into a captive program with a hospital as opposed to being insured by themselves. So we hear it from that standpoint. We see it in the hospital programs that we look at because we see the number of physicians that are employed increasing as you look at their evaluation of loss experience and exposure data each year. So it's continuing, but I think it's slowed some. I don't think we should have expected that it couldn't continue to go on at the pace it was going on. It would create some serious indigestion at some point if it did. So I think the pace is slow, but it is still, in my view, continuing.
There's an interesting component to this. We're now hearing over the last couple of years of a number of instances where when claims actually get to the point of litigation, where plaintiffs are dropping the individual physicians from various actions because if they're going to go into a court before a judge or a jury, from a strategic standpoint, they find it more advantageous to be going up against a corporate entity as opposed to individual clinicians with their own individual narrative and story and personality. So it will be interesting to see down the road sort of what are the economic impacts of those sorts of trends. Over time, it could bring about some interesting developments.
And one thing I'll add to what Jim was saying, and I wish I had these numbers in my head, but he mentioned the number of captives, NPL-focused captives that are popping up. And I think, I know we're working on a captive report now, but numbers that I remember seeing from an overall segment standpoint, there are more medical professional liability focused captives starting up than any other segment over the last several years. So again, I think in terms of the different solutions and the different alternatives that are being pursued in the marketplace, I do think that that's noteworthy that there are more NPL captives starting up than any other type. And I think we'll probably continue to see, as you talk about migration. Again, to Jim's point, it's not just a really easy kind of way to look at it. There are other elements and other kind of multi-layered elements to really understand what's going on in the marketplace. But that's as he mentioned captives, I did want to mention that.
I'll add one other migration comment. Since this started about 4 or 5 years ago, and there's been significant consolidations of employed physicians now. So we're waiting to see the migration out of the hospitals, but that really isn't occurring. But we do see some discontentment. It's completely changed for a lot of physicians. The employed setting is different than the hospital setting. It isn't that it's all negative. There's a lot of positive things about being an employed physician. But over the last 2 or 3 years, we've had quite a few comments coming back and forth. But you don't see where there is a migration out of the hospital network at this stage. We do see some where there's consolidations at hospitals where they're now migrating the physicians out unwillingly. In other words, they're moving and changing how their structures are from a medical standpoint. But it's something we're following and tracking as well.
Brian, you touched on telemedicine earlier. What do you see as the role of telemedicine?
Well, it's ubiquitous. It's everywhere. And if you ask 30 different people to define telemedicine, they'll give you 30 different examples or instances of it. Using virtual health or telemedicine, using technology to deliver care, I think we'd all agree it's a wonderful tool to help expand access to care for many people who are less able to get directly to a doctor's office or a clinic. And it's not just rural, although the medically underserved areas of America are one of the greatest beneficiaries of telemedicine or virtual health. But you can be in an intensely urban area and have just as much difficulty actually getting to a physician's office as someone who's 50 miles away. If you're an older person who has to navigate an apartment building, across city streets, wait for a city bus, and imagine it's winter time, there's a lot of benefits for telemedicine. Having said that, we have real concerns about who will be responsible, and there will ultimately be court cases that decide when there is a glitch, something less than perfect operation of the telemedicine tool being used, or whether it's a problem with the use of it by the patient or the patient's family. There's an array of litigation ahead of us. It's going to determine responsibility and liability for the use of the many, many tools. I mean, the fact of the matter is, it will become increasingly a part of the care of every single one of us. And yet, the liability component of it does not seem to be on people's radar screens. A couple of years ago, there was a forum in Washington, D.C. where one of our team was present, and when it was brought up by an array of healthcare experts, and they said, "No, your issues aren't really on the table," and we said, But aren't you talking about quality of care? Aren't you talking about access of care? Those are our issues, because someone needs to be there to point out that this is not just about reimbursement. This is about quality of care, safe patient care, and it's important that the MPL community be at the table to make sure that the interest of the doctors, the clinicians, and others using telemedicine are protected and respected as decisions are being made which are going to impact millions.
All right, we're going to take some viewer questions at this time. Jim Hurley, do you attribute large loss claims more to the consolidation of practices, groups, hospitals, opposed to severity, and as they put in quotation mark, shock value verdicts?
I don't think we've seen the full effect of physician-hospital consolidation in terms of severity yet. So I don't know that I would say it is manifest itself or a great contributor to the severity problem. I think it is a contributing factor and will perhaps contribute more as we go forward. But I would say it's more about high value verdicts. So while I hesitate to use the word shock value verdicts, clearly we are seeing more high-value verdicts that come along, and as I said earlier, the problem with that is that forms the basis upon which people evaluate the value of claims. So the follow-along to that is settlements. And so since only 5% or so of claims go to a verdict, the other 95% are being dragged along for the ride to some degree or another. They are influenced by what the concern is about what a jury is going to do with a set of facts, coupled with the fact that medical costs, which is the primary thing that's being paid for by a lot of these verdicts, are going up as well, driving the cost up. So life plans and things like that also contribute to it. But I think it's more, there's more to come on this consolidation of physician and hospital that's going to contribute to make its contribution to severity over time.
All right, we've got a question for our AM Best people. Is AM Best concerned with some carriers' pricing? Are they seeing signs of some carriers having financial difficulty?
I would say, again, we continue to look at it, and I'll probably, let Sharon give a longer answer to that. I don't know that we think any specific carriers right now that we're critically worried about. But again, this has been a prolonged soft market. Companies, again, have developed different strategies to try and fight their way through the market. Again, we were always looking at pricing. Again, it was interesting to see, like I said, the premium for the overall composite go up this year. We're wondering if that means companies are, as they are telling us anecdotally, getting some traction from a rate standpoint. But I don't know that there are any specific companies or if we're specifically worried about MPL insurers in general with regard to their financial security.
Yeah, and I think, we had talked about hearing companies starting to take rate in certain situations. I would emphasize that's not across the board. There's still some really competitive markets out there with significant price competition. So in those markets, we do see margin compression and accident year loss ratios start to go up. And as those reserve redundancies on older accident years diminish, that puts additional pressure.
And like, as you mentioned, just the accident year loss ratios continuing to go up. That is definitely a cause for concern from that perspective. But again, we'll continue to look at that, and I don't know that we have specific pressure, from the standpoint of our rating outlooks on any individual companies, specifically tied to how they're handling the prolonged soft market, rate-wise.
All right, we're quickly coming down and winding down to the end of our discussion. But before we do, David, I want to ask, what's AM Best saying about innovation in the MPL sector?
Well, innovation is something that we're looking at from an overall perspective. Last fall, AM Best issued a survey to the overall marketplace, and we got back about 450 responses, just trying to get a gauge on how companies are really focusing on innovation or innovative ideas to really impact their products, services, models, or what have you, in an impactful way that's producing some sort of measurable effect. And so we've kind of focused on that. We actually then from there developed a criteria specific to innovation that we've put out for comment. A couple months ago, the comment period is coming up here. I think it's ending May 13th. But from an overall perspective, what we're looking at is to see how companies are addressing it. And we're looking at it both from sort of an input and output perspective. How are companies, what are they doing, from an innovative standpoint, within their processes, within underwriting, claims, et cetera, to try and integrate different ideas to have a measurable impact. And then we're specifically looking at also the output. What are they able to take away? How are they able to measure it to see if it's actually having some benefit? So I think, again, the world as we know it, everything's moving faster. It's not that innovation has not been part of the marketplace, property casualty marketplace, or the NPL marketplace already. But we think because of how fast things are moving, we think it's more important to be on top of innovation and innovative ideas and to be able to integrate them into your operation and make better use of them. So I think that's something that, that's why we've developed a criteria that to have even more of a specific sort of transparent impact on our ratings analysis. And again, as the criteria, as we take in the comments and refine the criteria, I think we'll come forward with that. We're still at the beginning stages, but I think it's something that the market will continue to hear more from AM Best in that regard.
Yeah, and an interesting discussion at lunch, I think it was our Dan Ryan that said innovation does not necessarily equal technology, was it?
Absolutely, absolutely. Again, it's more ideas that are not, like you said, not just focused on technology, but different ideas that can be integrated and again, implemented in various aspects of an operation, but having some sort of measurable impact from a bottom line perspective. So I think that's what we'll be continuing to look at the rest of this year and as we go forward in our overall rating analytics.
All right, as I said, we are quickly winding down this hour. This is the part of our webinar where we like to go around our panel and ask each of our panelists what they think the key takeaway is here today, what they would like registrants to remember. And Brian Atchison, why don't we start with you? What's the key takeaway from today's discussion?
Changes in the air, innovation. I love that old Henry Ford expression. If I gave people what they'd want, I would have invented a faster horse. But when it comes to innovation, I think the concern has to be, having been both in companies and on the outside, all the technology in the world doesn't in fact make you better or smarter or more effective. When I think about, we've got this data sharing project, which is the largest ongoing database of medical liability claims for over 30 years. The second highest number of claims pertains to diagnosis, and that's still now. So you can take the best medical technology in the world, and yet ultimately you introduce the human factor. And that's the same thing about innovation and using technology, whether it's within any organization or elsewhere. So, I think it's an exciting time. I think we're going to have to try to come to grips with what our hospital section is talking about as the current hard market and reconcile that with the still ongoing soft market in the physician side. So, interesting times. We'll be looking at this next week at our conference in Portland, Oregon.
Thanks, Brian. Wayne DeNazari, what do you see as the big takeaway?
Well, I think everything we talked about relative to the segment, the NPL segment, very profitable, strong surplus, strong balance sheets. The future, as far as the direction, the consolidations will continue. The difference with the decline in the redundancy, there'll be pressure on rates. At some point in time, the underwriting profit has to be there. And so I think our main focus is underwriting profitability. And that comes through rates. You asked about our expansion. When you go into different states and different products and such, there's really no gap in the market. This is a very strongly capitalized segment. Very good companies, very, very good competitors, very fair pricing. So when you look at some of the dynamics that are occurring in the segment, with reserving, with reductions in reserve redundancies and such, you have to focus on underwriting profit. So that's our focus.
Thanks, Wayne. Jim Hurley, your thoughts?
Well, I think Brian and Wayne did a good job of summarizing a lot of the key takeaways from this. I guess I would follow up with it in saying that the companies are very well positioned to be able to do and respond to the challenges they face in terms of the market competition, the market challenges as far as exposure are concerned. So with those resources, they need to make the proper decisions about what's the right course of action for their respective companies. They have shown in the past that they are willing to invest in MPL, in patient safety, in the way of their investments in risk management, patient safety initiatives, and those types of things. I think they bring the ability with their resources to be able to help shape what healthcare should look like going forward, which I think was part of the original mission. So I think they're well positioned to do that. There's innovation to be made to help that come to fruition, but hopefully everybody will take their portion of the challenge and execute.
Thanks, Jim. Sharon Marks, what do you think registrants should remember?
Yeah, so I think the main takeaway for us is that although overall profitability continues, underwriting margins are still under pressure. We expect that to continue in the near term, given all the headwinds we've discussed today. I know my fellow panelists have touched on some of those with the prolonged soft market, shrinking demand, potential increases in severity. All of that's going to make for a very challenging environment. The segment has done a relatively good job of managing those conditions so far, but it is a challenge, and that's contributing to AM Best's negative outlook on the sector for 2019.
Thank you, Sharon. David Blades, you kicked us off. Take us home.
All right. I think, my biggest takeaway from hearing all the panelists talk, it brings back how dynamic this overall marketplace is. Again, everything that's going on in the healthcare marketplace, over the last several years, the focus that's been on it, and all of the different elements, of things that are impacting MPL insurers. I think there's a lot to look at from an analytical perspective, from an AM Best perspective, but I think there's a lot that's on the plate, obviously, for these companies in terms of pushing forward through the prolonged competitive marketplace, things that they have to do to be successful on an ongoing standpoint. So I think there's even more for us to pay attention to make sure we understand just what the companies are facing and how the initiatives that they're implementing and how they're attacking this marketplace to continue the resiliency. You still see the resiliency in this marketplace in terms of operating profitability. So again, we talked about the headwinds, but I just kind of take away just how dynamic this marketplace is, and there's a lot to continue looking at. Even just one discussion about loss reserves. There's so many elements, so many layers to talk about. And I think we'll continue to focus on that going forward. But the dynamic nature of this marketplace kind of really struck me as everybody kind of went through and offered their different perspectives.
Thank you, David. Thank you, panelists one and all, for an outstanding presentation here today. We'd like to let our viewers know that we will have a full replay of this webinar posted within the next day or so. Full transcript will be out within the next couple of weeks. For AM Best, I'm John Weber.